Ladies and gentlemen, good day and welcome to JK Tyre and Industries Q1FY23 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Basudev Banerjee of ICICI Securities. Thank you, and over to you, sir.
Hi, thanks. Warm welcome to all participants in the Q1FY23 JK Tyre post-result conference call. And thanks to the management for giving us the opportunity to host the call. We have with us representing the company Mr. Anshuman Singhania, Managing Director JK Tyre, Mr. Arun Kumar Bajoria, Director and President, Mr. Anuj Kathuria, President India, Mr. Sanjeev Agarwal, Chief Financial Officer, and Mr. A.K. Kindra, Financial Advisor for JK Tyre. Over to you, Mr. Anshuman Singhania, for your initial comments and discussion on the call. Thanks.
Thank you. Good afternoon, everyone, and a very warm welcome to JK Tyre's Q1FY23 earnings call. And thank you all for joining us today. I am Anshuman Singhania, Managing Director. I have with me Mr. Arun K. Bajoria, Director, President International, and Mr. A.K. Kindra, Financial Advisor, and Mr. Sanjeev Agarwal, CFO of the company. Further, I am very happy to introduce you to Mr. Anuj Kathuria, who has recently joined us as President to look after the Indian operations. Mr. Kathuria brings with him 31 years of rich experience, having worked in senior management positions in the leading auto companies, including Ashok Leyland and Tata Motors. Now coming to the performance, JK Tyre recorded yet another quarter of highest ever sales of rupees 3,650 crores, registering a remarkable growth of 39% vis-a-vis Q1 FY22. This has been achieved on the strength of the highest sales in the domestic market, replacements and OE. During the quarter, export volumes were sustained despite global disturbances. There is a continuous focus in increased exports to targeted geographies across North America, Latin and Middle East. The automotive industry in India is definitely showing positive signs of robust demand in FY23. We expect the demand to further grow during the second half of FY23. There is a sharp increase in CV volumes driven by MHCV and LCV sub-segments in the domestic market due to improved activity in road construction, mining, along with growth in agriculture and e-commerce activities. Further, there is a noticeable growth in the bus segment on the block of reopening of schools, offices and surge in travelling post-pandemic. Domestic tyre demand continues to be buoyant on account of higher vehicle utilization emanating from improved economic activity, domestic consumption and a strong preference towards personal mobility, resulting in robust demand for CV and PV tyres in both replacement and OE segments. The utility vehicles witness a significant growth, reflecting the changing preference towards UVs, which is now constitutes almost half of the total PV domestic sales. We have been continuously increasing our volume in these categories and ramping our volumes further in this premium, more so in the higher end sizes. On the outlook of tyre industry, we believe multiple demand drivers create India's growth story and demand outlook in the automobile and the tyre industry. Despite global fears of slowdown geopolitical disturbances, and supply chain constraints. We believe the domestic consumption and healthy infrastructure spend will drive the growth in the near future. CV, which is a major revenue contributor for us at 56%, is expected to benefit from the structural upcycle over the near to medium term. Raw material and other input costs witnessed an ongoing uptrend which impacted the margins. The company has undertaken a periodic price increases. Operating profitability improved on quarter-on-quarter basis, mainly on account of operating leverage, efficiency improvement, and price hikes. Raw material cost increase is likely to continue in Q2FY23, based on the lag effect which we expect to pass on through further selling price increases. Going forward, some moderation in the raw material prices is likely due to correction in crude oil and commodity prices. We perceive further improvement in margins from H2FY23 onwards. As announced earlier, we have successfully completed the debottlenecking program to unleash PCR capacity at our plants in Banmore and Chennai in the previous quarter. Further, with regards to TBR and PCR expansion, both the projects are under implementation and are progressing well. Risk identification and mitigations are essential to sustain our growth in this dynamic business environment affected by the market turbulence, technological advancements, and constraint of raw material availability. We have a strong and prudent risk management framework to identify excess and quantify all possible risks and concerns that may affect the company's performance. At JK Tyre, innovation and technology are the core pillars, and each of our product categories is ahead of its time to meet the needs of our customers and industry. With the evolution of EV sector in India and development of EV-oriented technology remains a key focus for our company. Further, our focus on ESG and digitalization is driving us ahead towards excellence in this era of sustainable development. We remain committed to strengthen our process to offer better experience to the customers. Now I would request Bajoria ji to talk about the performance of our subsidiary companies.
Thank you, Anshuman ji. With regards to the JK Tyre subsidiaries' performance, both the subsidiaries continue to contribute well in terms of overall revenue and operating profit. Cavendish Industries Limited recorded highest ever net revenue of rupees 942 crores in Q1 FY23 as compared to rupees 687 crores in Q1 of FY22, the corresponding quarter, registering a growth of 37%. Operating margins at CIL were under pressure due to unabated increase in input costs. JK Tornel, Mexico, continued to perform well despite global disturbances. During the quarter, JK Tornel achieved highest ever turnover of Mexican pesos 1,750 million, which is equivalent to rupees 673 crores, as compared to Mexican pesos 1,278 million, equivalent to rupees 471 crores, which is an increase of 37% in peso terms. Operating profit at Mexican pesos 155 million, equivalent to rupees 60 crores, is an increase of 36% in peso terms on year-on-year basis. There has been significant improvement in operating parameters at JK Tornel, Mexico, with plants running at 90% and volumes increasing each subsequent quarter. Now, I request Mr. Agarwal, our CFO, to bring about the financial performance of the quarter.
Thank you, sir. Thank you very much, and good afternoon, everyone. Let me now take you through the key highlights of the financial performance in Q1FY23. The consolidated sales were recorded at rupees 3,650 crore, which is the highest ever as compared to rupees 2,618 crore in the corresponding quarter, registering an increase of 39% on year-on-year basis. The average capacity utilization was 90% during the quarter. Export revenues were recorded at rupees 458 crore vis-a-vis rupees 476 crore in Q1 of last year. Profitability at EBITDA level in Q1 FY23 was recorded at rupees 291 crore as against rupees 289 crore in Q1 FY22. Operating profit margins were recorded at 8%, which is up by 90 basis points as compared to the previous quarter. Cash profit for the quarter stood at rupees 190 crore and profit before tax stood at rupees 57 crore. Our finance cost in Q1 FY23 has declined by 8% on YOY basis to rupees 99 crore as against rupees 108 crore in the corresponding quarter. We are following strict credit discipline and efficient cash management to lower our working capital in business and unblocking of funds to minimize the impact of the recent hike in interest rates. The leverage ratios of the company remains within a comfortable zone, and we remain committed to deleverage our balance sheet through reduction in long-term borrowings going forward. We have already circulated our earnings presentation, which is available on our website as well as on the stock exchange website. And now we open the forum for question and answers. Thank you so much.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
Yeah, hi. So firstly, on this capacity expansion, our current PCR capacity is 14.5 million tires, right? And how that will go up to after expansion?
So as we have discussed earlier in our last conference, the total capacity will become 123 million, and the total increase from the number 123 lakhs in fact, and this is 35% increase from the debottlenecking of our plants. So which was at 90 lakh tires, and now this will become 120 lakh tires, 123 lakh tires.
So 90 lakh will go to 123 lakh tires. This is only India, right?
Yes.
And where we are currently?
So we are somewhere in between, because we have already, as Anshumanji said, earlier we have completed already the debottlenecking of program of our company at both our tire plants, and we are now working on the expansion plan. This is a brownfield expansion of rupees 530 crore for the PCR.
So, and post that, how much capacity will go to? This 23 is without that, right?
No, as I said, the total is 123 is with the expansion.
Okay. And TBR expansion, how we are planning? Current capacity is 3.7 million. How this will go up to?
40 lakh tires it will become post the expansion.
And this should come by this year?
Yeah, I think we have already given the date, some March 23.
Okay. And secondly, Mexico is doing pretty well. I think our profits have increased EBIT from 31 to 47 crores. Margins also improved. So is there no impact of commodity inflation in that market? Any reason why we are doing so well, and how should we look at it going ahead?
No, there is a similar price increase in the raw material in Mexico as well, but we have been able to pass on most of it, and therefore you see the profitability better than what you've seen in India. And going forward, I would only say that if there is no abnormal price increase continuing, then I think you should see similar results in the coming quarters as well.
And lastly, last year we had received a 90 crore subsidy incentive from government. Was there any amount received in this quarter as well?
On receipt basis, yes, we have received some amount during the quarter as well.
How much that was?
No, so this is not bifurcated for the previous financial year or for this financial year, because this is an accumulated amount which we have received during this quarter, and this is for the past couple of years as such. So not bifurcated as such, but yes, we have received a good amount of the incentive from the government, which is nothing but the reimbursement of the GST, which was paid on the local sales.
We received in this quarter or last year?
This quarter.
How much was the amount, total amount?
Roughly around 150 crore. 150.
50 crore.
150. 150.
150 crore is the amount received in this quarter, you're saying?
Yes. This is on receipt basis, as I said initially. This is on receipt basis, and this could be an accumulated amount for the previous years as well. So on receipt basis, I'm telling you the amount.
No, but sir, I think at console level, our EBITDA in this quarter is 270 crores. If you are saying that 150 crores is just the incentive amount, then actually EBITDA is quite low.
No. That again, let me clarify. I am telling you what we have received, and the EBITDA shows that what is accrued in this quarter. Accrued and receipt are both the different things, right?
So is that amount 150 crores is part of your other operating income?
And I clarified also, just a minute please, I clarified also that this pertains to also for the previous years.
No, I get that thing. I'm saying that if you look at this quarter, your EBITDA is 285 crores, for the console level. And if the 150 crore amount received for previous year as well as current quarter, then actual EBITDA should be much lower.
No, you are not understanding. I'm really sorry. Can we take up the next question, please?
Okay, fine. Thank you.
Thank you. The next question is from the line of Nisarg Vakharia from Revanta Funds. Please go ahead.
Yeah, good evening, gentlemen. Just wanted to understand one, you've written a 500 crore brownfield capex. since we have sort of front-ended a lot of CapEx over the last few years, so till what round of brownfield CapEx do we not have to incur a large greenfield CapEx again? I mean, how many brownfield CapEx rounds can we do over the next 3 to 5 years?
So at the moment, we have been expanding the capacities for TBR and PCR, and I think this another expansion of PCR could be possible because there is always some imbalance in the capacities created over the period of time. So
Yes.
we can continue to go ahead with the brownfield expansion for PCR one more time, probably, and then we will relook at and revisit the situation, and then we will accordingly take up the greenfield expansion, if any. In any case, this will also be a part greenfield because we have been expanding capacities at our existing plants only.
Okay. Right. Okay.
Just to add what Mr. Sanjeev Agarwal has said, it is a very dynamic situation, and as he said, we will keep looking at the demand available in the market, and then as the situation demands, we will certainly keep planning further expansions.
Okay. No, sir, because a lot of tire companies that have invested into radial capex, whether it's you or Apollo, have done a lot of capex over the last 4-5 years. So we are just trying to understand that now a large part of the country is already radialized. Incrementally, will the capex requirement be lower than what it was 3-4 years ago, hence putting lower stress on our balance sheet?
So I think we have answered your question, or...
Okay, that's fine. Second question is that, sir, resuming from the previous participant, Shitosh, just to clarify, your existing EBITDA does not include 150 crores received from GST, right?
That's correct. So whatever was accrued during the quarter, that only becomes a part of the current quarter's earnings.
Perfect. Okay. And the balance amount goes in cash flow, but it does not go through the P&L.
Absolutely. Right.
Perfect. Okay. That's the clarity. Number 3, sir, that we have a dominant position in truck and bus radial tires. Now, you mentioned that in other parts of the world, like you mentioned Mexico, even though there has been adverse impact of raw material, we could easily pass on the price increases to the customers. Now, do you foresee a situation like this ever emerging in India? I mean, we have, suffered a lot because of raw material disruptions, but somehow all players in India are not able to pass on these increases together to the customers. Do you think that situation can change at this point of time?
Well, here the company has taken a price hike in the tune of 4% in Q1 FY23, and we may take further price increases of nearly 2 to 3% in Q2 to moderate the impact on the margin. So these are all dependent on the market condition. So here India being a very price-sensitive market, there we have to play by the market conditions and the environment. Whereas in the export or Mexico, there usually the prices are passed on immediately in the market, and that is absorbed.
I'm assuming because of the discipline that is maintained by all tire manufacturers, right? It's not only you.
Yes. Yes.
Okay. Lastly, I wanted to ask you that is there a target of debt reduction that we would like to sort of look at over the next 2 years? What should we... Last quarter, if I remember correctly, we were at 5,200 crores of debt. What should be that debt number be over the next, let's say 1 year or 2 years? And number 2, what is the... Assuming we don't do any capex, as a hypothetical scenario, what is the maintenance capex that we have to incur per year just to maintain and sustain the existing gross block?
Okay. So let me take your second question first. So every year we are incurring almost about 150 crore for the maintenance of our plants, all plants, on a consolidated basis. I am giving you this number.
Okay, sir.
And this is per year basis.
Yes.
And as far as the term loans are concerned, the debt position, basically you asked me.
Yes.
So we will be repaying almost about 400 crore rupees of debt. So this is different, of course, some bit of pluses and minuses in each of these years. But broadly, the number is 400 crore rupees annually. And we will be repaying by FY25 another 1200 crore rupees of long-term debt. And as far as the working capital is concerned, this is all, of course, we have been keeping a very tight control on the working capital and trying to optimize the working capital levels. But we have seen that this is directly proportionate to the business and the operations of the company. And in the last 1 year, in fact, this has increased significantly because of the input cost increase and also the operation levels which has gone up significantly. So broadly, the point is that we will be able to repay our debt by almost about 1,200 crore rupees by FY25 from now.
That is okay. So that is essentially long term, but working capital also, as you mentioned, there is a temporary increase. So if that normalizes, how much debt should be squeezed out of that normalization of working capital?
So on normative basis, if we see that the total borrowings on account of working capital in the company as a whole should be in the range of about 1,800 crore.
Okay.
And the long-term debt, which is standing at about 3,000 crore rupees, that will come down by about 40%. So
okay.
to maybe 1,600 crore. So that should be the position on debt front.
I got it. Okay. Great, sir, and all the very best to you. Thank you so much for answering all my questions.
Thank you.
Thank you. The next question is on the line of Nirav Saxeria from Living Root Capital. Please go ahead.
Yeah. Hi, sir. Am I audible?
Yes.
Yeah. So my first question is, so can you give the breakup of revenue growth by price and volume?
The overall revenue growth in terms of our net sales. Here I would say that we have been able to grow by 39% at an overall basis.
Okay.
And in terms of the quarter, the volume growth was 22% and 17% was price.
Okay, sir.
Overall was 39% growth on a consolidated basis for the quarter.
Okay, sir. And so the other question is, due to the increase in raw material basket, how much price increase do we have to take to cover it up?
So as I said that our raw material front, we have seen a 5% increase in quarter one in FY23. That requires around 4% selling price to be increased. So we have taken already a 4% price increase in quarter one. Further, we are expecting to take 2 to 3% in quarter two in this FY23.
Okay. So that will basically, to follow it up, it will cover up the previous raw material increases?
No, that not fully. It is not going to cover up the previous year price increase of the raw material.
Okay. So, sir, can there be any rough estimate in the future that we might take to cover it up?
So, can I answer?
Yes.
So basically, what Anshuman has just said, that the next price increase of 2 to 3% in the quarter two, which we are expecting to take, or we are intending to take, actually is also dependent on the increase in raw material prices. That is one point. So that it clarifies that there is no increase in prices for the past under recoveries, right? And in future also we will see that how much price increase in raw material is taking place. So based on that only, we will take the price increase to recover the under recoveries of the previous year.
Okay, sir. Okay, thank you so much, sir. That's all from my side.
Thank you.
Thank you.
Thank you. The next question is on the line of Dinesh Gandhi from Motilal Oswal. Please go ahead.
Hi. Just wanted to clarify, the cost increase in 1Q was 4% is what you indicated, right?
Yes.
And what kind of cost inflation we do see for second quarter?
So as I said, between 3 to 4%, and in fact the first quarter cost increase, raw material price increase was 5%, the impact was 4%. And in the case of Q2, 3 to 4% raw material price increase is likely, and the impact of that would be between 2 to 3%.
2 to 3% of sales. Okay, got it.
Yeah, because this raw material constitute about 65% of the selling price, so that way we have calculated.
Sure. That is, no, that's fair point. And second question was with respect to our capex. So for FY23, what kind of capex number should we budget for?
So we have been progressing well, as we have in fact talked about, and because the total capex earlier declared, including the maintenance capex, is for about 1,100 crore. So this is to be spread over 2 years. So exact amount, as because we have started and working on the ordering at the moment. So, but we expect that at least 40% of the total amount of capex will be incurred in this financial year.
Got it. And lastly, with respect to our utilization levels, how it would be in India now? You mentioned terminal is about 90%. How would be for Indian capacities for TBR, PCR?
Similar, Mr. Dinesh, this is similar in the case of India and as well as in Tornel. So overall is 90, but broadly it is the same for both the companies, entities.
Got it. Okay, sir, great. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Noel Vaz from Asian Market Securities. Please go ahead.
Yes, hello. Thanks for the opportunity. So I just had one query. Is actually related to the exceptional item which has happened in this quarter for about 35 odd crores. So that is due to adverse FX movement, right?
Yes, so I tell you that this is majorly on account of the unrealized mark-to-market loss which we have worked out on the term loans. Because there are term loans in foreign currencies in the company, in all the entities, and this is the unrealized loss. Major part of this is unrealized loss. And because the currency has got depreciated, Indian rupee, has got depreciated at a very fast pace in the recent few months. So that is the reason for this basically unrealized loss or notional loss, I would call it.
Basically mark to market. You see, you have to mark your foreign currency liabilities to the market rate as prevailing as on the last day of the quarter. This is the effect of that only. Now, fortunately, you post June, the rupee has started appreciating. But unfortunately, whatever was the rate prevalent as of 30th June, we had to translate our liabilities to that only. So that's why this impact has come.
Is that point clear?
Yes. That's very good. Follow-ups.
Sorry to interrupt, Mr. Vaz. We are not able to hear you clearly, sir.
Hello, can I be heard?
Sir, your voice is sounding muffled.
Hello, can I be heard now?
Yes, better.
So actually, just a follow-up. So in case the rupee does depreciate further, then would we see, or say if it appreciates very sharply, then would we see some kind of a write back or even a further exceptional item? Is that a possibility?
So as per the accounting standards issued by the Institute of Chartered Accountants, we have to make mark to market of the term loans, let's say as at the end of the quarter or financial year, whatever. And because these are foreign currency loans, and if the rupee depreciates further, of course, the impact will come. But as far as the guidance which has been given to us by the experts on foreign currency, so they have been talking about a range, and in future, and this is my very personal opinion, that it may not be the case in future. So the major impact of that has already been factored in, and in case of rupee appreciation rather, we will be able to recoup the notional losses, and this will become unrealized gain in fact.
Okay, thank you for clarifying. That's all from my side.
Thank you.
Thank you. The next question is from the line of Mitul Shah from Reliance Securities. Please go ahead.
Thank you for giving me opportunity, and congrats on a very strong operating performance. Sir, I have a question on export revenue. It seems that export revenue has come down despite, even if you adjust for this currency benefit, then there is a more decline since the volume decline is sharp. Is it right understanding, and can you give more details on that?
Well, the export performance has maintained a high base number in Q1 in FY22 despite challenges in geopolitical economic conditions and intensified competition from Southeast Asia. It has been possible to sustain our export on account of our quality of products, best-in-class service with our customers. More so, the demand of JK brand tires of radial continue to be sustained across the geographies. And we continue to strengthen our position in North American markets. In order to sustain and continue growth of our export, we are focusing on intensifying and strengthening our brands in the international markets. There has been, in fact, a sharp increase in our value and the mix to North America as compared to the first quarter, last year, corresponding quarter. And we have also strengthened the Europe, Middle East and Asia as well. So we are continuing, and plus we are seeing a good demand which is also coming our way here in India. So we are looking at good outlook for tire industry here in India. There are multiple drivers as mentioned earlier because of the infrastructure and other areas. Growth in the short term and in the long term looks to be good.
We initially highlighted price hike is around 17%. So I assume more or less similar price hike in export market also, and currency benefit in the range of 5 to 10%. So if we put together, volume decline seems to be very high double-digit decline. Can you give volume percentage decline or any number on that side for exports, sir?
No, so for exports, there is no volume decline as such, right? And this is when we compare it with the corresponding quarter. As compared to the previous quarter, definitely there is some volume decline is there. But as Anshumanji just now clarified, that there is a first preference, of course, to the domestic market, and because there is a demand which is picked up in the OEM segment as well as in the replacement market segment. So the production first has catered to this market, and then, of course, to the export markets, where, of course, we have been also strengthening our position, particularly in North America and Japan, but still, yes, there is a volume decline compared to the previous quarter.
Okay, sir. And going forward for next 2-3 quarters, this Q2 onwards, which segment do you see outperforming OEM, replacement or export?
We see in the OEM, the demand is coming back, particularly in the CV segment, which was muted for a long time. And we see because of the infrastructure and push, there is other core industry coming back. For example, cement, steel, other industry coming back. We see CV market to have a good demand come back. We are seeing that in the PCR, car vehicles also, the chip shortage is looking like easing out, and there is a good demand which is going to be coming in that sphere. Because of the good monsoon, we are also seeing there should be in the season time from the next quarter, we are seeing even the tractor sales to be coming back. And 2-3-wheeler is muted, but 2-3-wheeler will surely pick up.
With good monsoon, things should improve, economy should improve.
The overall sentiments is there to improve in terms of good monsoon. So we are seeing that it is good demand which is coming our way.
Yes, sir. So accordingly, then our mix will again go back in a normalized way, wherein replacement used to be roughly around 50-55%, right? So last time replacement was around 54%, YOY I'm comparing. This time it has come 60%. And as replacement margins are high, so we got benefited from this favorable mix. But going forward, if it normalizes and higher growth comes from the OEM side, can we expect some moderation on the margin side?
Margin side, there would be some moderation, but I would say it would be on the positive side, because CV market, which was very much muted, and particularly in the OEM, will have a good traction coming. So I don't think so there should be any negative impact on the margin. In fact, it should improve the margins.
Okay, sir. Lastly, can you give some indication or approximate volume guidance for FY23 for industry on replacement and OEM side?
No, that will be very difficult to estimate the volume guidance for segment-wise.
Okay, thanks.
Thanks.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Jatin from Invest Savvy. Please go ahead.
Yeah, good evening, sir. Am I audible?
Yes, sir. Please go ahead.
I have one question that you have mentioned about your short-term borrowings that is going to come in the range of 1,800 crores. So by the end of this current financial year, that you have mentioned that will reduce.
I said this 1,800 crore rupees of borrowings which are there today, that is likely to come down to about maybe 1,600 crore. That is what we are planning, and we are optimizing our working capital. But this is also directly linked to the kind of the operational level of the utilization of our capacities. So today we are operating at 90% level, and as we have been making efforts to increase it to maybe towards 95% going forward, because there is a very good demand in the market. So the working capital requirement initially may move up also. So, but we have been keeping a close check and optimizing the utilization of working capital.
Okay. And one more question, sir. You were saying that by looking at the commercial vehicle demand outlook, and you are also taking a periodically price hike. So you are just trying to maintain your margin also. So I am expecting, can we expect some kind of, double-digit guidance, operating margin, going forward?
So going forward, we expect the margins to improve, but this is all depending upon, again, the kind of raw material price hike increase takes place. So, and because of our endeavor to increase volumes as much as possible, take the market share as much as possible. So let's see, but we are hoping for a better margin scenario going forward.
Okay, and last question. Sir, due to, some kind of, recently we have seen the natural rubber prices at a very lower levels. So, just for my reference, the company is benefiting from it because in news we have seen many times that natural rubber prices are at a very lower level. So, just to give some, idea about that can be beneficial for the company.
Yes, this will be certainly beneficial if it continues at this level, and we are hoping for the best.
Okay, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Amit Agarwal from Leeway Infotech. Please go ahead.
Sir, good evening. My question is regarding the rubber prices. Have they already come down compared to the last first quarter? And if the rubber prices keep on going down, so is there any chances of rolling back of the prices or tires?
Well, the rubber prices, it is a basket of rubber prices, synthetic rubber and carbon black, which is 170 rupees per kg, 185 per kg and 130 rupee per kg. Natural rubber, synthetic rubber and carbon black. Vis-a-vis the fourth quarter of 22, that was hovering around, rubber was 163 rupees per kg and 178 kg synthetic rubber and carbon black 111 kg. These prices have certainly come up from the vis-a-vis the previous quarter 4, and now we are seeing from H2 levels some sustainability should come in there. So that is one. The other thing is the price increases which have been taken in the replacement market. They will certainly be sustained, and we are hoping that this escalation of raw material should be in a stabilization form.
So, is there any lag between the oil prices and the rubber prices? Because oil prices have come down compared to quarter 1, I suppose, or maybe right now the oil prices are down. So, is there any lag, or is the impact immediate?
No, there is always a lag effect which there is in terms of crude oil prices coming down and how it is impacting the derivatives of the raw material. So there is always a lag effect which is there, and certainly it will be reflecting on better price of raw material improvement.
So what is the margin expansion should we expect in H2? Margin expansion I'm talking about.
Margin expansion, as I said earlier, it's very difficult to actually predict at this point in time when we are seeing so much of uncertainty globally. And just to take one more point as far as the raw material is concerned, it's not that the crude oil prices started to come down. It may get reflected once, because there is a lag effect, one, and secondly also the demand supply for its own actually will determine the price for any raw material, be it the synthetic rubber or maybe the carbon black, because the demand and supply for that particular raw material also decides what kind of prices would be there in the market. But yes, directionally, I think if the crude oil prices started to come down, which part is seen, and other prices, then it will be it will be lower kind of increase in raw material prices, and then we can expect to get some expansion in margins.
But can you name a figure by 2% or 3% or something like this?
So we have clarified this point also earlier that next quarter we are expecting the raw material prices to move up by 2 to 3%, and we are also hoping for the increase in the prices for our products by the same percentage points.
You mean quarter 2 or you mean quarter 3?
Quarter 2.
Okay.
Quarter 2 we have been talking about, right?
And my last question is like, as we all know that the interest rates are going up. So right now the demand is from across board. So, but by next year.
Sorry to interrupt, sir. Your audio is breaking up.
So my question is, interest rates are going up across board, and right now the demand is very strong across.
Sorry to interrupt, Mr. Agarwal. Your audio is not clear, sir.
Just hold on. Then. Hello. Is that audible? Am I audible?
It's still the same. Sir, it's still the same.
Hello.
Sir, can you use the handset mode while speaking and not?
Yeah, I'm using the handset mode. Is it clear?
No, sir, it's not clear.
So then I skip the question. Hello.
Yes, sir. Sir, we would request you to disconnect and reconnect.
Okay.
In the meantime, you can take the next question.
Thank you. We'll move on to the next question. That is in the line of Mitul Shah from Reliance Securities. Please go ahead.
Thank you for follow-up opportunities. Sir, I have a question on Mexico operations. How is the industry situation there, and what kind of industry growth we expect from that, or any market share gain, and what is our situation there?
The industry scenario in terms of the tires in Mexico is quite good, I would say. And going forward, our capacity utilization should increase. And as we said that we have achieved 90%, and we are hoping to achieve higher capacity utilization going forward. Because the demand is quite robust, not only in Mexico, but also in the other Latin American countries.
So what is the ratio over there now in terms of export versus domestic consumption there?
This is about 70-30. 30% is export and 70% plus is domestic consumption.
So in next 2-3 years, what kind of opportunity do we see on the export side from there? Or what this 30% can go up to, what is our aim?
I would say that a few percentage points only, because there is a very strong domestic demand, and we would not like to miss on the domestic market shares as well as the numbers that we can sell locally. And our profitability is quite good on the domestic front, and it is actually similar.
And sir, in this, secondly, on this export side from India as well as Mexico, whatever currency benefits recently has happened because of the sharp movement, so are we able to retain it, or we need to pass it on partially or completely? How is the competitive situation in all our markets?
So that is, in fact, the currency movement benefits whatever accrues because of whatever the sharp move or slow move. So that accrues to the company. So this is because the discussion for the export in the export markets is for the dollar per sale, right? So the benefit accrues to the company in any case, whether it is in India or in Mexico.
Okay, sir. And lastly, on market share domestic side, can you give some ballpark number or YOY or Q-on-Q improvement on whatever 2-3 key segments?
In the domestic side, as I told you, that CV market, so that means the truck radial looks to be good on that. The PCR is looking good. and we are hoping that even tractor will sort of come back with the good monsoons. This is what we are looking at.
Sir, I am asking for our market share position here in this segment. Hello.
We are trying to better our market share in all these segments. Certainly, we are trying to not only maintain, but we are trying to better our market share in all the categories which I mentioned.
Sir, do we follow any hedging strategies as our export is now becoming sizable?
So the hedging strategy we definitely follow, and which is as per the company's foreign exchange management policy. And this is at the moment we have seen that most of our imports are hedged through the natural hedge, which is through exports, and which is up to the level of 75% on trade front. And in the case of the term loans, we have almost like 60% of our loans are fully hedged. So that is the broad guidance which has also been given under the management policy, foreign exchange management policy. So we are following that policy, and still this is because some of the loans are hedged through the structured products. So that is how you have been seeing some kind of effect of volatility and the currency depreciation in our financials. But this is all notional, and I hope that we will be able to recoup this in the next
we as a company do not indulge in any speculative hedging or anything. We do not take very exotic derivative products and all that which are available in the market. I think as Sanjeev has explained, we have a very definite policy of hedging on a net foreign exposure basis, and we adhere to that.
Absolutely.
Thank you, sir, and all the best.
Thank you.
Thank you.
Thank you. The next question is from the line of Noel Vaz from Asian Market Securities. Please go ahead.
Hello. Yes, actually just one follow-up question. So regarding the capex, so just to confirm, the growth capex over FY23-24 is estimated at about 1,100 crores and 40% to be incurred in FY23, right?
Right.
Yes. And so just to wrap up also, maintenance capex run rate should be about 150 crores per annum. I think that is what you said earlier in the contract.
This is included in 1,100 crore which we have talked about.
Okay.
So
Okay.
2 years of the maintenance capex of 150 crore rupees each for each financial year is included in this. So just to recap, as we have also announced earlier, I will give you a broader picture again. So PCR project, which is there for expansion for 530 crore rupees, brownfield expansion, and then for TBR 236 crore rupees, and 300 crore rupees of maintenance capex.
Okay. Yeah, that I just wanted to just confirm. Thank you very much.
Thank you.
Mr. Noel Vaz, are you done with your question?
Yes, that is all from my side. Thank you for letting me know.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star in 1. The next question is from the line of Amit Agarwal from Leeway Infotech. Please go ahead.
Yes, thank you for giving me the opportunity again. My question is regarding the interest rates and the scenario. Interest rates are going up across board. So do you see any slackening of demand by the middle of next year? And if yes, how will they affect our margin? Because debt margins have been low historically for last 5-6 years.
So on the contrary, just to answer your question, we have been seeing a very good demand in this financial year as well as in the next financial year, because I was just reading one report there, the freight has gone up significantly post-pandemic, and this has come to the level of almost about the pre-pandemic levels. And the India growth story, which is very good today, and we do not expect any slackening in demand even in next financial year. Even if the interest rate scenario is, let's say, against us for the time being, but we do not see any slackening in demand even in the next financial year.
Yeah, but surprisingly, we have only three, four companies, big companies in the domestic market. So historically, the margins are always low, like 2-3% net margins, which should be around 8 to 9% for a company like ours, such a big company, and margin should be 8 to 9%. What is your explanation, or what is your thought process for this?
So this could be a reason of various factors, including the product mix and the kind of the markets we have been serving in. Like in the case of our company, we have been selling also in a big way in the OEM segment, where the margins are comparatively lower compared to the replacement market. So the product mix, the segment mix, the market mix, so many factors actually are there which determines the margins. So we are not very off the margins which are there in the other companies, probably.
And in fact, just to add there is that raw material has been the major constitutes of this margin. So hopefully this which we will be able to catch up to better our realization, so then we'll be able to get better margins.
Okay. And anything you want to say about the EV market? Like, what is your plans for EV market?
EV market, we are very focused on the EV story. We are very carefully tracking the EV. We have already made EV truck tires. We were the first company to put EV truck tires on bus tires on buses. We are continuing with robust product strategy in all our categories for EV. We are already in advanced talks with the OEMs, and we have launched our EV product range in the market as well, with all categories of truck, bus, then even PCR and two and three-wheeler as well.
Do you need some capital expenditure on the like conversion from the normal tires to EV tire production?
The production happens on the same production facility of the normal tires. It is on the same lines, so you don't have to invest on separate lines. But their technology plays a very important role.
Okay, thank you. Thank you from my side.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for the closing comments.
Thank you. Thank you very much. I once again thank you for joining the call today for Q123. And we hope we were able to reply to your questions to your satisfaction. And I, on behalf of JK Tyre, once again, thank you very much.
Thank you. Ladies and gentlemen, on behalf of ICICI Securities, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.